We'll be waiting 2 more minutes, then we'll go with the session. Okay.
Recording in progress.
Yes. So I hope yesterday's session concepts were clear. Yes. Anything you want me to ask from the yesterday's session? Yes. So today first we'll be starting with company objectives. Now very interesting concept. So I believe we'll have a productive discussion on this, and I request the participants to please actively participate for this. Now, in general, what do you think? What would be the objectives of the company? It means I'm speaking from an entity point of view. What would be the objectives? So, according to you, what objectives a company might have? Because as a finance manager, we need to understand the objectives of the company. See, we can't say that every company will have objectives, will have same objectives. It differs upon it differs company to company. And here I'm getting very interesting answers. Uh, Profit maximization. So most of the participants thinks profit maximization, increase in profit. Very good, very good. Profit maximization and good working conditions to employ. Excellent. And growth, yes. Expand business, profit maximization, increase sales. And very interesting point, risk management and sustain in the market for a long time. Excellent. So by seeing your answers, I get an opinion that already you became a professional finance manager. Yes, whatever responses you are giving, these are very good. Sustainability, good customer service, diversification of business, excellent point. You used a very good term, diversification of business. Uh, Next, optimization of resources. Yes, definitely a company need to think about the optimization of resources. It can be the financial resources or human resources or any other resources. Next, profit maximization and sustainable management, customer satisfaction. Then fulfill the pre-planned objective. Yes, a unique point. Now, I think you mean to say that every company will be having a specific goal. So, whatever the goal which is fixed by the company, so achieving that particular goal. I hope this was the point you want to mention, right? Increased production, survival, profit growth, adoption of new technology. Yes, this is also good point. Yes, increase in the value of their market shares. Excellent point. Increase in the value of market shares. Corporate social responsibility to be more environmental friendly, ensuring the stakeholders of the entity. Yes, I am very thankful to the participants for your responses. I appreciate your efforts. Very good. Yes. So excellent customer service. Yeah, very good. So it means that most of the participants generally believe that profit maximization should be the main objective of the company. And they also mentioned that a company will be fixing a specific goal, and achieving that particular goal can also be considered, yeah, employee satisfaction. And some students, some participants responded that employee satisfaction should be there. Now here employee satisfaction means providing a good work environment and paying the compensation appropriately. That can be considered as employee satisfaction. And some students also focused on diversifying their business. Excellent point. It means that they want to expand the business and diversify in the different pools. It means entering into different markets. Suppose example, if a company previously was in the business of banking, now they want to go with an insurance business, or they want to go with an infrastructure business. This is considered as diversification. Yes, very valid point. Now, companies might think about diversifying their business, and some participants also responded that the company want to increase their market capitalization. Nothing but they want to increase their share price in the market. Excellent. So that would also be considered as market, objectives, company objectives, and providing good services to the customers. Nothing but better customer service. Yes, valid point. This can also be considered as one point. And achieving growth in the company. It means that let us growth in the sense comparing their present performance with the previous performance and achieving an increase. Suppose previous reporting year, if the company profit was, let us assume that $1 lakh. Now the company might be having an objective to reach their profits to $2 lakhs. So that can also be considered as one of the objectives. Yeah, yeah, very good responses from the participants. Now, generally, if you see the company objectives, we can segregate as a primary objective and the secondary objectives. Now, the secondary objectives can also be considered as other objectives. Now, here first we try to focus on the primary objective. Now, every here company in the sense, do remember I am focusing from a listed company. Okay. So whatever we are discussing about the objectives, we are discussing from a listed company perspective. I hope please keep this point in your mind. So the primary objective of the company is maximizing the shareholders' wealth. So the primary objective of the company is maximizing the shareholders' wealth. Now we try to understand what is this maximizing the shareholders' wealth. Okay. Now let me explain this with a small illustration. Let me open my Excel sheet. I believe with this particular sheet, you can clearly understand the concept. Yes. Now we try to understand what is this maximizing the shareholders' wealth. Now, maximizing the shareholders' wealth means increasing the market capitalization of a company. Suppose, let us assume that we are having two projects. Now, you just assume yourself as a finance manager. Your company want to go with a new project, and we do have two alternatives: alternative A, alternative B. These are two alternative projects. Okay. Now, let us assume that the lifespan of project A, the lifespan of project A is 10 years, and the lifespan of project B. It means once the project starts, we can expect cash inflows from the project for a period of 10 years. It means the project is having the capacity to provide economic benefit to the entity for 10 years. So the lifespan of project A is 10 years, and the project B lifespan is, let us assume that 20 years. Right? Now, let us assume that For the first 10 years, for the first 5 years, one to 5 years, the company annual cash flows, nothing but the expected economic benefit for the first 5 years from the project A is 50,000. And in case of project B, the first 5 years expected economic benefit is 20,000. Now from 6th to 10th year, the expected economic benefit is, let us assume that 75,000. And from project B, we are expecting an economic benefit of 60,000. Now 11 to 15 years, because the lifespan of project A is only nothing but 10 years, so there will not be any economic benefit. But here we are expecting 80,000. Now 16 to 20, now here we are expecting around 1,20,000. Now let us assume that we need $1 lakh to invest in the project, because in order to start the project we need 1 lakh. So by considering the prospective information of these two projects, now generally which project you prefer? Will you be going with, as a finance manager, will you recommend your company to go with project A or project B? I think most of the participants' response is project B. Can I know the reason why project B? Now, don't you think in case of project A, for the first 10 years, it is giving high economic benefit compared with project B? Akash? Yes, Akash. Yeah, you can unmute and you can share your opinion. Akash, I can see that you raised your hand. Any query from your end?
No, sir, it mistakenly
Yeah,
happened.
yeah, yeah. No issue, no problem. Yeah. Here I'm getting answers because long term is good, but the lifespan is small. So that's why you don't want to go with project A, but the project B is long term compared to project A. Now, what is the advantage? If the project lifespan is high, what is the advantage to the company? So the first advantage is, let me see the responses. Wealth maximization, smart enough to give the answer. But here, Mike, how it will contribute for the wealth maximization, Vandana? Yeah, now let me explain this. Now, if a company goes with a project which is having a high lifespan, now it can minimize the what is this investment risk. It means that in case of project A, after completing the project for 10 years, again we need to search for a better investment opportunity, and we don't know whether we will be succeeding in that particular project or not. And next important thing is because the primary objective of the company is to maximize the wealth holders, shareholders' wealth. It means that if a project is having high lifespan, definitely it contributes the wealth maximization. Why it contributes for the wealth maximization? The first important is the span is 20 years, and in this particular 20 years, if you carefully focus on the different phases, I hope you might be aware. Generally, a company initially they will have a phase of entry. After the entry, then a survival phase. After the survival phase, then they will have a growth phase. After the growth phase, generally they will have a diversification phase. It means that if a project life span is high, it allows the company to go for the diversification, which is very important for maximizing the shareholders' wealth. Because if you see in case of project A, let us assume that they might have come out of the entry phase, then this they done with the survival phase. Then After reaching the growth phase, again they need to search for a new project because the project lifespan is only 10 years. Now, it won't allow them to go for a diversification phase. But in case of project B, already an existing project is there, which is having a remaining span of 10 years. Now, in these particular 10 years, the company can maximize their retained earnings. And with that particular retained earnings, definitely the cost of capital will be very less or it is negligible. And that particular amount can be used to diversify their pool. So if a company uses that particular amount for the diversification, definitely the value of the shareholders will be maximized. So I hope this particular illustration is clear to understand about the diversification. Sorry, wealth maximization. Is that clear? So it means that as a finance manager, you always should focus on maximizing the shareholders' wealth. Of course, there might be a conflict in this. It is not necessary that always the finance manager or the company might succeed in wealth maximization because in company, if you see, you will be finding the different stakeholders. If you try to benefit a one shareholder or one stakeholder, it might create an adverse effect on the other shareholders. Right now, we try to have a detailed discussion on this, but I hope you understood the concept of wealth maximization here. So it means that the company always try to maximize their wealth by choosing the project which is having long span. And second important thing is they always try to maximize it by increasing their market capitalization. So market capitalization in the sense increasing their value of the firm in the market. So this should be considered as the wealth maximization. And next paragraph, if you see, the objective underpins many of the techniques used in financial management. Here, the use of NPV for investment appraisal. Now, NPV in the sense, anyway, we do have this concept, a separate chapter for NPV calculation. But here, in order to know whether the project is having the capacity to maximize the shareholders' wealth, we do consider the NPV technique. Now, generally, if a project NPV is high, if a project net present value is high, we believe that it contributes the maximization of wealth of the shareholders. So let me know if you have any query on this primary objective of the company. Is that clear? Yes. Yeah. Now next is the other objective. In addition to the wealth maximization, so it includes service levels, the quality of the products, staff welfare, environmental concerns, social responsibility, profit maximization, growth, market share. Now, anyway, we can link the market. And now here, don't confuse here. Market share doesn't mean that share price. Here, suppose example, what is a share of a company in the market? Let us assume that if a company is in the business of electronic gadgets, suppose if you take some famous brands like Apple or Samsung or other brands, if you keenly observe around maybe around 10 years back, the complete, especially if I take mobile market, so the complete market, approximately more than 70% of the market was captured by, there was a famous company which captured this market of mobile. I'm speaking around 10 years back. Any idea about this? Anyone? Exactly. Very good. Very good. Nokia. Now you might have observed a drastic fall of the market of Nokia. Now, can anyone rate which company maximizes their market in the present scenario in the mobile? Which company? Any idea? MI, Apple, Samsung. Okay, OnePlus. Now, if you observe around 4 years back, It means what when this particular smartphone was introduced into the market. So this Samsung company capitalized. It means they captured the complete market of smartphones. But after the launch of other brands like MI or OnePlus or others, I'm unable to recollect, and seriously I'm not aware also the brands which are available in the mobile. But if you see, it means what I'm trying to say here is last 1 year and 1.5 year. Don't you think there is a perfect competition in the mobile market? Now, previously, most of the customers, they prefer to go with a brand. Yes, now also that particular trend is there. But what I'm trying to say, the options, the scope is not there. The scope is not there to explore. But nowadays, most of the companies are entering into the smartphone with different features, and with that particular entering into the new market, you can observe a significant decrease in the prices of these smartphones. So when the company is working under the perfect market environment, so the present market for the mobile can be considered as perfect market environment. In that case, the company tries to maximize their market share, because it is not that much easy to maximize their market share. So we suppose some of the participants says that Apple, Samsung, and MI, uh, they do have a good market share. Yes, I completely agree with you. But if you keenly observe, we don't know which mobile will be coming next day, and we don't know how it will be performing. Right. So that's why the maximizing the market share nowadays became a very important objective of a company, and the service levels. Now, some of the participants already mentioned, spoke about this service levels in a sense, how effectively or the quality service which you are providing, how the company is providing the quality service to the customers. Then quality means if it is in the business of manufacturing products, so how they are, whether they are maintaining the quality standards or not. So that's why you can observe most of the companies are going with the quality accreditations nowadays, ISO. And even if you take educational institutions also, most of the educational institutions nowadays you can see NAC accredited or NB. It means that in order to project their quality, in order to give an assurance to the stakeholders regarding the quality, they are preferring to go with this quality assurance bodies, because these are a non self-regulatory bodies which mainly focus on the scrutiny of the quality standards of the entities. So this can be considered as one of the objective. Staff welfare. Suppose if I ask you to compare the Reliance company and the Tata company on this particular element, which company you rank more, the Reliance or Tata, from the staff welfare perspective? Yes, very good. Now, generally, I hope you might be aware, Tata is ranked in the top 10 when it comes to the human resources. So most of the companies, they will also focus on the staff welfare. But do remember, definitely there is a possibility of conflict in achieving these objectives. See, anyway, that we do have a separate element in this chapter. We'll focus that. But staff welfare is nothing but how, what kind of benefits an entity is providing to their what is this staff members or the employees. Now, can anyone pick a company which is ranked in the top five when it comes to the staff welfare? Which company is ranked in the top five in the world? I hope you got my query. Which company do you think that it is ranked in the top five of the staff welfare? Generally, most of the people, yeah, very good. Infosys, okay. Google, E&Y, Google, E&Y. So there is a very big competition between Google and E&Y. Okay, Facebook, Microsoft, Wipro, very good for your response. I appreciate you. Now, generally, Google can be considered as one of the company which is very employee friendly. It means it's mainly focused on providing a friendly work culture and the environment. So, and the environmental concerns. Nowadays, the environmental focus is very increasing. It means that the company, in addition to focusing on financial objectives, they should also focus on the non-financial objectives like environmental concerns. It means in order to achieve, let me give a small example. Two companies are there. Let us assume the company X and company Y. Now, company X is both the companies are in the business of uh, production of medicines, right? They are in the business of pharmacy, right? Or pharmaceutical companies. These two are pharmaceutical companies. Now, company X, the return on capital employed for the current year is 23%. Company X return on capital employed, or in simple, the company net profit percentage for the current year is 23%. But company Y net profit percentage for the current year is only 16%. So company Y net profit is 16% and company X net profit is 23%. Now company X uh, is contributing around more than 4% in pollution in the companies which are in the pharmaceutical. It means what I'm trying to say, the company X didn't went for the advanced technological or nothing but advanced machines which will minimize the pollution in the process, in the production process of these pharmaceutical products. Because the reason is they don't want to invest on those machines because those machines won't increase the productivity. They will contribute only to minimize the pollution which is caused from the production process of those products. But the company Y installed those machines and they are using those machines and they minimized the pollution caused by the company significantly. So because of going with that those kind of advanced machine, the company Y net profit is only 15%. And because the company didn't went for those kind of machines, the company X net profit percentage is 23%. Now, as a stakeholder, now which company do you think will survive in long run? Nothing but which company mainly focus on the economic environmental issues? Definitely company Y. Of course, because here the company X is mainly focused on the profit maximization because the main agenda is profit maximization. They don't want to invest a single penny on a machine which contributes in minimizing the pollution because they are not expecting any economic benefit from that. They assume that it is only a non-financial objective aid. But company Y, they are very much concerned about the environmental issues. And believe me, the next maybe 3 years or 4 years, there is a very huge demand for sustainable reporting. It means that integrated report. Nowadays, of course, integrated reporting is not mandatory, but you can find that maybe in another 5 years or 6 years. Now, most of the company law boards or most of the economists might what is this consider this integrated reporting as mandatory. Now, integrated reporting in the sense just projecting your financials is not sufficient. You should also project your non-financials. Of course, if a company get a profit of 1 lakh, at what cost you are getting the 1 lakh profit? If you are not following the environmental issues, and because of not following that, if you are maximizing your profit, then definitely it might create an obstacle in the long run for the company. So that's why this integrated reporting it is going to play a very important role maybe in the coming years. And it won't be surprise if a company specifically recruit the people who are well versed in this integrated reporting. And we are very thankful to ACCA that they give very good importance for this integrated reporting, and it is there in your professional level also. So one objective is environmental concerns and social responsibility. I hope most of you might have heard about CSR, corporate social responsibility. Now, whatever they earn, it means that uh, during the reporting year, whatever they earn, how much they earn and how much they invested for the upliftment of the society. Now, there is a very interesting thing I want to discuss. Now, most of the companies, if you see, they are trying to project their business model in a social perspective. Now, let me show a small example. What is this projection of business model in social perspective? Just I am taking the annual report of Reliance company of the previous year. Let me project the annual report of Reliance company. Just give me 1 second. I hope everyone can see my screen. Yeah. Now here you can see some of the highlights of this Reliance company. So the company consolidated turnover was approximately 6,59,205 crores, and the net worth of the company also you can see. Now what I am speaking is, now just see this one. It means they are including these the secondary objectives as the primary objective. It means that how they are contributing, what is their wealth creation. It means that wealth maximization doesn't mean that only from the shareholder point of view. Just increasing the shareholders' wealth doesn't mean that wealth maximization. It should also focus on the wealth maximization of other stakeholders. Other stakeholders means it can be the finance suppliers, nothing but the debts providers. It can be the employees of the company, and it can be the other elements of the society. Right here you can see, compared with 2018 and 19, if you see 19 and 20. So the wealth created by the Reliance company to the providers of debt. So previously it was 27,749. Now it increases to 30,280. It means what I am trying to say, most of the students generally they think that wealth maximization is related to shareholders. Of course, it is mainly focused on shareholders, but not only the shareholders. It also focus. It means the finance manager need to plan the resources in such a way that it should contribute for the wealth maximization of other stakeholders also, like employees, society, and suppliers. All this. Now, the point which I am addressing, if you see the business model of the Reliance company, now here just see this. Now, if we take Geo platform, now generally the business model of Geo platform is to provide in the internet service, and in addition to that, it also provide certain services. So through that particular service, they are generating the income. But how they are project? It means that if a company succeeds to project their business model from a social perspective, definitely it will survive in the long run. Now here also, here you can see they are using this particular geo platform to provide the services to different uh, participants, nothing but merchants. It means that merchants are using this geo platform to make their payments. It means what I am trying to say, of course, they are generating the income, but they are projecting that because of this particular geo platform, the small and medium scale industries, nothing but small and medium scale merchants are using it to make their payments. And it is providing, it is acting as a link between a final consumer and the small merchants to process their business transactions. It means, I hope you can understand, this is a projection in a social point of view. And Geo also says that because of providing the bandwidth at less cost, the rural India also had an option to utilize the network. And with that particular utilization of network, most of the students, what is this, got an option to upgrade their technical knowledge. It means their business model, they are projecting in a social way. Social way in this sense, it is benefiting to the society. So our main agenda is to convert our business model, which is useful for the benefit of the society. For a better understanding, we can take Swiggy as an example. Now, the what is the business model of the Swiggy? To act as a channel between the service provider or the food provider to the customer or a consumer, right? Now, how they will project in a social way? We are contributing to what is this to satisfy the hunger of the public. That is projecting in a social way. Now, the Zoom platform which we are using, the business model of the Zoom platform is to generate to get maximum subscriptions from the account holders and generating the income. But the social projection is acting as a channel between a faculty and a student so that student can upgrade their knowledge. I hope you understood my point. Is that clear? Shall I assume that you understood the point? If a company succeeds in projecting their business model in a social perspective, then definitely it will survive in the long run. Any query on this? Now here you can see Geo platform acting as a solution for the industry ecosystem. So they are using for commerce, education, agriculture. Okay. So I request the participants to please let me know whether you understood the social projection or not. Is that clear? And the social projection also mainly focus on how much benefit an entity is receiving from the society and how much cost a company incurred on the society. Now, as per the corporate social responsibility CSR, there are certain it means some companies are there which contributes 1% of their profits for the upliftment of the society. I hope most of you might have heard this. Say during this particular pandemic also, some big corporates contributed some specific funds at this pandemic stage. So that can also be considered as an initiative relating to social responsibility. And the next objective is profit maximization. We'll discuss in detail about the profit maximization. Then growth. So achieving the growth and the market share. Already explained about the market share. Now, when it comes to profit maximization, now in addition to wealth maximization, finance manager will also be focusing on maximizing their profits. It means how to increase the return on capital employed. So here we can see profit maximization can be adopted as an objective, especially when the managerial performance targets and rewards are linked to the ROC. Now let me uh, explain this. Now generally, whoever executive staff is there, nothing but a chief executive officer or chief finance officer or whoever connected with the governance of the company, it means operational activities of the entity. They are very much focused on profit maximization. The reason is their remuneration is linked with the performance of the company. So once again, I repeat, if the directors or the key members remuneration is linked with the performance of the company, then they might mainly focus on the profit maximization. But the major issues with the profit maximization is generally this is a short term and it is more risk, and non-cash based measures can permit manipulation of results, and the same concerns can also be applied to earning per share growth. It means that uh, for the benefit, it means for the purpose of maximizing their remuneration, these particular persons who are involved in the operational activities of the business, they might focus on maximizing the profits. It means, suppose if a finance manager, when he is making investment decision, by considering the profit maximization as a main motive, then definitely there is a possibility that it might succeed only in the short run. It might aid the it may not aid the company for the long term success, and it can be more riskier because most of the short term investments are considered as most risk. And very important point is non-cash based measures can permit manipulation of the results. Generally, permit manipulation of results in the sense. Do anyone understood this point? Anyway, I will be giving an example, but before that, I want to know from you what this statement means. Non-cash based measures can permit manipulated results. What does it mean? Just make it right. Non-cash based measures can permit manipulation of results. Not exactly credit based, but it is one element which we can consider, but not exactly. Now, let me explain this. Non-cash basis means, I hope most of you might be aware, while preparing our statement of profit or loss account, we do consider certain elements like non-cash elements like depreciation or a profit on sale of assets. Now, let us assume that if a company intentionally dispose an asset, and if you compare the sale proceeds with the carrying value, if the sale proceeds are more than the carrying value, we do consider it as profit on sale of asset. Now, don't you think this profit on sale of asset will maximize the profit? Or for your better understanding, let me put it in Excel sheet. See, there are, let us assume the two companies are there, X Limited and Y Limited. So the total sales of X Limited is 1 lakh and Y Limited is 70,000. Cost of sales of X Limited 60,000 and here 50,000. So let us assume that the gross profit of the company of X Limited is 40 and Y Limited is 20,000. And other operating expenses 10,000. Here also, let us assume that 8,000. And during the year, Y Limited disposed an asset and they got profit on disposal of asset. The profit on disposal of asset is 40,000. So finally, net profit of the company. So X Limited net profit would be how much? 30,000. That is 40 minus 10. Now in case of Y Limited, 20 minus 8, it will be 12,000 and profit on disposal 40,000. So total it will be 52,000. Now if you see, the net profit of the Y Limited company is 52,000 and the net profit of X Limited company is 30,000. Now by considering the net profit, definitely we assume that the performance of Y is better compared with X, right? I hope you agree with me. I hope you understood my point. If you consider the net profit as a base, which company is performing good? Y Limited only, because the Y Limited profit is 52,000. But what is the fact here? Actually, the 40,000 is a non-cash element. That is a profit on disposal of asset. This is not relating to the operating activities. So the directors, in order to maximize their profit, why they want to maximize the profit? Because their remuneration is linked with the profits. So these kind of strategies, technically speaking, this is known as a window dressing. We can say it as window dressing. They might intentionally do this act so that they can project their higher profits and they will be getting benefit from that particular higher projection of profit. So this is one issue with profit maximization. I hope this illustration is clear. Any question? If you have any query on this, you can unmute and you can let me know. Yes. So here intentionally, if this non-cash element would have not there, then the net profit of the company would be only 12,000. But because of including this, because in this while preparing the statement of profit and loss account, we do consider this. So the directors might intentionally to deal with these kind of things so that they can maximize the profits. So if you don't have any queries, we'll be going with the next one. Yeah. Now, if you see the corporate stakeholders, generally the stakeholders includes shareholders, community, debt holders, customers, employees, government, management, and the other environmental groups. Now, the key point which we need to consider here is a stakeholder group is one with a vested interest in the company. So, all these debt holders will be having an interest in the company. Customers will also see, generally, always a customer wants the company to supply a quality product with less price. And always employees will expect that the company should pay higher compensation to them, and government want the company to pay higher taxes. Management, it means the people who are involved in the operational activities or in the management activities, they always tends to maximize the company profit so that their remuneration will also be increased. And the environmental groups, they always focus on what is this the sustainability of the company. Sustainability in the sense they should not affect the environment, right? So every stakeholder will be having their own interest in the company. So the company will thus have a multiple objectives often in conflict. It means that because there is no uniform interest among the shareholders, every stakeholder will be having their own unique objective. So because of this, there is a possibility of conflict of interest. Now, always a finance manager need to go for optimize nothing but he need to prioritize the objectives. It means that it is very difficult to satisfy the interest of all the stakeholders. Very, very difficult. So here the finance manager need to focus on prioritizing these objectives. Now here you can see the principal. Principal is nothing but the shareholders, agent, nothing but management, third parties. So here you can see I hope you can see this particular diagram. Can you see this? I'm expecting the participants to respond.
Yes, sir.
Yes. So here my point is it is very difficult to have a uniform interest among the stakeholders. So definitely there is a possibility of conflict of interest, and it is the responsibility of the finance manager to minimize these conflicts. So in order to minimize these conflicts, he need to prioritize the objectives of the stakeholders. So generally, if you see the principal is nothing but shareholders, agent is nothing but the managers who are actually involved in the regular activities of the entity, and third parties, nothing but debt holders or the financiers, government. Okay, we'll have a detailed discussion on this. Now, this we consider it as agency theory, and do remember we can expect a compulsory MCQ from the concept of this agency theory. So, the objectives of the shareholders, that is principal, and the managers, agents, may not coincide. It means the problem of goal congruence, hence the design of alternative remuneration schemes. Now, let me explain. Before explanation, just I want to ask a question. Managers always expect profit maximization, and shareholders always focus on wealth maximization. So managers always they want to, in order to maximize their profit, there is a possibility that they will be involving in those acts which maximizes the profit rather than wealth. But agents are expecting different from their sorry, principal is expecting different from the agent, because agent is expecting profit maximization, principal is expecting wealth maximization. Principal in the sense shareholders. Now, as a finance manager, what would be your solution? So, how you can minimize this particular conflict? Because two stakeholders are having two objectives. One is wealth maximization, and other stakeholder is having profit maximization. So, as a finance manager, what do you think? How we can minimize these particular conflicts? I hope my query is clear. So, what do you think? How a company can, how a finance manager can go with that? By providing shares to the managers and making them a shareholder, making them a shareholder. Okay, very good. Yes. So, as one of the participants said, here we can provide shares to the managers. Now, generally we say it as ESOP, Executive Share Option Scheme. If the shares are provided to the managers, now there they will also be mainly focusing on maximizing the shares, because they will also be benefited from this. So there are certain examples which can be considered to minimize the conflict. So the first example is a bonus based upon a minimum level of pre-tax profit. So bonus based upon a minimum level of pre-tax profit. So it means that if a company achieves a minimum profit, then a bonus will be paid. That's it. And over that particular level, there will not be any remuneration to the. Suppose, let me give an example. A company can say that sorry, it means that a company can fix that if they achieve a profit, net profit of 10%, then a 0.5% is payable as bonus to the directors. And if the company achieve more than 10%, then there will not, it means that only the benchmark is to achieve 10% net profit. That's it. So that can be considered as one of a strategy to minimize this issue. Then a bonus linked to the economic value added. It means that instead of focusing on the profit maximization, here we can give a bonus on the value addition by the company during the year. Value addition means how much, suppose example, previous year the market capitalization of the company is 1 billion. Now this year the market capitalization is 1.5 billion. It means there is a value addition of 0.5 billion during the year. So if you can link that particular 0.5 billion to the performance of the directors, then that can also minimize. It means in simple, we are converting the profit maximization objective into wealth maximization. Because here the value of the firm has been increased from 1 billion to 1.5. So on that particular value addition, if you can declare remuneration to the directors, then it can also minimize the issue. Then a bonus based on turnover growth. So it means that instead of focusing on the profits, if the bonus is declared on the turnover in the sense sales. Let us assume the previous year the company sale was 1 lakh and this year it is 1.5. So that increase of 0.5 is nothing but growth in the turnover. So this can also resolve the issue with intentional overstating of profits by the directors. And the last one, as I already mentioned, issuing some shares to the executives. So technically it is known as ESOP, that is executive share option scheme. So any query on this, the 4 points? I request the participants to please go through these 4 points and let me know if you have any questions.
Sir, could you explain the second point once again, please?
Bonus linked to the economic value added, right?
Yes, sir.
Okay. Let me show it in Excel sheet. Example, in 2020, the total shares of the company was 1 lakh and share price in the market is $10. In 2021, there is no change in the shares, but share price in the market has increased to 15. So the value of the firm, the market capitalization or the value of the firm in 2020 is 10 lakhs. In 2021, it is increased to 15 lakhs. So the value addition will be 5 lakhs. So 15 lakhs minus 10 lakhs, the value addition is 5 lakhs. So if we can link or we can fix the remuneration on this value addition, then the conflict between the agent and the principal can be minimized. This is known as value addition concept. Now, how the value is increased? By increasing the share price only, right? When the share price was 10, the value of the firm is 10 lakhs. When the share price increased to 15, the value of the firm increased to 15 lakhs. So if you can encourage the agents to increase the value, so technically increase the value is nothing but increasing the share price in the market. Now, don't you think it is wealth maximization? Now here you are giving the benefit or you are compensating the directors for maximizing the wealth. So this is known as wealth addition. Nothing but economic value added. I hope economic value added point is clear. Let me know whether I addressed your query or not. Yes, thanks for the response. And First point, okay, let me explain the first point. That is a bonus based upon minimum level of pre-tax profit. Yes. Yeah, here EVA in simple economic value addition means, in simple terms, if you fix the remuneration of the directors on the basis of increase in the share price in the stock market. It means if the company share price increases, then you will be paying nothing but you will be giving extra compensation to the directors. If you are linking the remuneration of the directors with the share price of the company in the market, that is known as economic value addition. So if the company value increases in the stock market, the directors will be getting higher remuneration. So that is EVA. I hope it is clear now. Let me know whether I address your query. Yes. Now we will go with the first point. Some participants asked me to explain the first point. That is a bonus based upon a minimum level of pre-tax profit. Okay. See, let us assume that in 2019, net profit of the company is 50,000, right? So the shareholders or the principal said that in 2020, if a company receives or if a company get a net profit of 60,000, then they will be getting a bonus on reaching this particular target. It means that the company said that we will be paying 1% as bonus. The company will be paying 1% as bonus if the company reaches 60,000 profit. That is known as paying the bonus on minimum level of profit. It means we'll fix a benchmark. So we are planning. So current year our profit is 50,000. We are expecting that the next year our profit should be 60,000. So if you achieve the 60,000, then we will pay 1% bonus. That's it. So no matter how much you achieve more than 60,000. It means if the company profit is 70,000 or 80,000 or 90,000 or 1 lakh, they will get only 1% as the bonus. That's now 1% bonus in the sense on 60,000 only 1% they will be getting the bonus. They won't get the bonus on 1 lakh or 80,000. It means in order to uh, minimize the acts of the directors to overstate the profit. Here, don't you think directors won't overstate the profit in this case? Because their target is only getting the 60,000 profit. That's it. If they achieve more than 60,000 also, they won't get any compensation on this. If they achieve 60, 1% of 60, they will get bonus. That's it. This is known as fixing or issuing the bonus on the basis of a minimum pre-tax. I hope it is clear. And one more important point, here we will be considering the pre-tax profit. Now let me share this. Net pre-tax profit means before considering the tax. Why pre-tax profit? Anyone? Why not post-tax profit? Why pre-tax profit? If you fix post-tax profit as a benchmark, then the company directors might intentionally may follow certain tax evasion techniques to maximize the post-tax profit. I hope you understood. Let us assume that a company should pay a tax of $1 lakh, but in order to maximize the post-tax profit, they intentionally decreased the tax payable amount. So there is a possibility of this act. So that's why we can consider a pre-tax profit as a benchmark. Now, can I assume that you understood the concept? Is that clear? The first point. Now these are the 4 points. Next, examples of non-goal congruent behavior undertaken by the management. Now let me explain this. Okay, let me explain the last point. So the last point is an executive share option scheme. This is very simple. Executive share option scheme means uh, whoever the key employees are there, most of the companies they will issue some shares to the key employees at free of cost. It means what I'm trying to say, their package includes the shares. Suppose if an employee annual package is 1 million. Now in that 1 million, 40% relates with the shares. It means they won't pay any cash. Instead of paying the cash as a compensation, the company will issue some free shares to the key staff members of the company. This is known as employee share options. Instead of paying the compensation in cash, they will be issuing their shares at free of cost. Now, the basic reason, the main reason for issuing the shares is if an employee is also having the shares, or don't you think he will tries to maximize the share price in the market so that the conflict, whatever the conflict is there between the agent and the principal, can be minimized. Okay. So I hope the last point is also clear. Next one. So examples of non-goal congruent behavior undertaken by the management. First, let me explain the example, then we'll discuss about this. Excessive remuneration levels, empire building, creative accounting, off balance sheet financing, inappropriate reaction to takeover bids, and unethical activities. Now, can anyone let me know what exactly this non-goal congruent? Any idea about this non-goal congruent? Just think about it. What might be this non-goal congruent? Just I will be giving 1 minute time. So just think about it. Unethical practice. Okay. So one response I got that unethical practice. Others. When employee goal and company goal doesn't go align, giving importance to their benefit more than the company benefit. Yes, very, very good. Perfectly correct. One. Just give me one. Yeah. Yes, as you said, generally, if the goal of an individual and the goal of an organization doesn't matches, that is known as non-goal congruence. Now, here the steps, the examples which we can consider is excessive managerial remuneration levels. Suppose if a company is offering an excessive remuneration levels to the key personnel of the organization, then that can be considered as an act for non-goal congruence. Empire building. Now, empire building means this key staff member who are actively participating in the key management affairs of the company, they might focus on empire building. Empire building in the sense, in future, they may go with management buyout. There is a concept called management buyout. So in that case, whoever the key staff members are there, they might compel the shareholders or to sell the company to them. So empire building is a starting phase for this management buyout. And creative accounting. So in order to get excess remuneration, the agents might go with creative accounting. It means they might use the loopholes in the accounting so that they can project an overstated profits. Then off balance sheet financing. Any idea about this off balance sheet financing? Because these are the key terms which we can expect for your MCQ. Yeah. Choosing shell companies, yes, to a certain extent, correct. Any other answers? Selling of assets and not recording it. They will not show certain items in the balance sheet. Okay, very good. Assets or liabilities are not recorded in the balance sheet. Okay. Now, what is the purpose? Why a company might not record the assets and liabilities? Is there any hidden strategy? Okay, let me explain this. Now, generally, if you can recollect, yesterday I was uh, saying about gearing ratio. I hope you might have recollected that gearing. So the company, if a company wants to minimize their gearing ratio, they might intentionally not disclose, especially certain liabilities in their financial statements. That is known as off balance sheet financing. Okay, they might use the loopholes of the accounting policies and they might not disclose certain liabilities. Suppose, let me give a best example for this. If a company, but if a company took in any asset on lease basis, if a company took an asset on lease basis, as per IFRS 16, we need to recognize a liability in the statement of financial position. Nothing but in the balance sheet, we need to recognize a liability. This is mandatory as per IFRS 16. Now already the company gearing ratio is 50%. It means the liabilities are more than 50% of their equity. Already the company liabilities are more than 50% of equity. And if they recognize this particular lease liability, then it goes furthermore. It means that it may be around 60% of their equity. Always a company need to maintain a gearing ratio of less than 40%. It is not suggestible for a company to go for more than 40% of gearing ratio. But in the given example, already the company gearing ratio is 50. And in addition to that, if they recognize the lease liability in their statement of financial position, it goes to 60%. Now, in this case, the managers of the company may go with off balance sheet what is this balance sheet financing. In this case, instead of recognizing a liability in the statement of financial position, they might recognize this lease as an operating expense in the statement of profit and loss account. Because already they are having a high gearing ratio. To minimize that, they might recognize the lease as an operating expense. So this can be considered as a best example for the off balance sheet financing. I hope it is clear. Any query on off balance sheet financing? Empire building in the sense, see, let us assume that there is an ex-limited company is there. Now, in this ex-limited company, 7 board of directors are there. Now, these 7 board of directors are working in the company from the last, let us assume, the 7 years. Now, they want to build their empire in the sense they want to go for a management buyout. It means they want to purchase the company from their shareholders. Now, in order to purchase the company from the shareholders, I hope most of you might be aware about this. They might intentionally understate the performance of a company for a specific period of time. It means they say these directors can project that the company are in losses. Of course, the company is in profits, but they project that the company is in loss to the shareholders. And they will create such a situation that shareholders believe to dispose the shares rather than continuing their investment. So they will compel the shareholders to dispose, and the management will buy that particular shares from the shareholders so that they can go with building their empire. So it means the managers will be converted into the shareholders. This is known as empire building. I hope I addressed your query. Now, most of the companies you can find this. Now, unethical activities, I don't think I need to give an example. So, whatever unethical activities the company might perform. Yeah, creative accounting means here using the loopholes of accounting policies. Suppose if you can recollect this example, where I did. Yeah, this one. Now, don't you think by using the accounting policy, I overstated, I window dressed my net profit here? This is an example for creative accounting. Just window dressing. Actually, its position is different, but I am projecting in a different way. Because as per accounting policies, I can show profit on sale of disposal in my statement of profit or loss account. So by showing the profit on sale of disposal, I overstated the net profit. But actual performance of the company is different. Actual net profit, if I won't consider the profit on disposal, is only 12,000. But by adding 40,000, I'm projecting my net profit as 52,000. This is known as creative accounting. So using the loopholes and overstating the profits is known as creative accounting. Is that clear? I hope your query resolved. Now next one is unethical activities. Now here let me give a best example for the unethical activities. Now normally if a company want to purchase any raw material, if a company want to purchase a raw material, generally there is a specific procedures. Now procedures in the sense, first they need to invite the tenders from the supplier. After getting the tenders from the supplier, they need to select a tender where the cost is quoted less, nothing but least quoted tenders will be selected. After selecting the tender, a purchase order should be raised, and after raising a purchase order, the process for purchase should be initiated. So this is certain procedures which are to be followed. Instead of following all these things, the production director, nothing but the purchase director, he purchased the raw material from his relative because he didn't invited any tenders. One of the supplier is his relative. So he placed the order with his relative and he purchased the raw material. Now, don't you think it is an unethical activity? I hope it is clear about unethical activities. I can't say it as illegal, but it is unethical because the company do have certain procedures to be followed. They need to invite the tenders. Instead of inviting the tenders, if they prefer to give an order to the relative of a purchase director, it is an unethical activity. Yeah, inappropriate reaction to the takeover bids means same example we can take. In a takeover bids in the sense, suppose example, if X limited company is there and Y limited company is there. Now let us assume that Y limited company uh, placed a bid, nothing but Y limited company want to purchase the X limited. So I want all the participants to listen carefully. Very interesting point. Y limited company want to purchase X limited company. Now Y limited offered $100 per share to the shareholders of X limited company. Once again I repeat, Y want to purchase the X limited company. Y limited offered $100 per share to the X limited company. Now in this case, the present share price of X limited in the stock market is 80. The present share price is only 80. So that's why Y limited offer 100 to the share. Now in that case, the shareholders want a detailed performance projection of X limited in future. It means that they will expect a projected performance report from the management. It means that today the company share is 80. So what are our current projects? With our current projects in future, what will be our share price? So it is a responsibility of the management to give this detailed report to the shareholders of X limited company. If the management didn't respond in proper way, it means instead of giving a clear report to the shareholders of X limited, if they give an inappropriate report, and with that particular inappropriate report, if the shareholders of X limited decides to sell their shares to the Y limited, then that can be considered as an inappropriate reaction to the. So from the manager, inappropriate reaction in the sense, if a Y limited company gave a takeover bid, then it is the responsibility of the management of the X limited to give clear report to the shareholders regarding the future performance of X limited. If they won't respond in a proper way, that can be considered as inappropriate reaction to the takeover bid. I hope this example is clear to understand this.
Sir, but what is their motive behind that? I mean, what do they get
You can
by?
guess it, na? Don't you think? Just try to guess. What might be their motive? Y
Fine.
limited might have offered a certain what is this illegal benefits, right?
Okay, okay, I got it, sir.
Yeah,
Okay.
management of Y limited, what they might have said is don't give a clear report to the shareholders. If you give the clear report, they won't agree to sell the shares. So if you go with the inappropriate reaction, we'll pay certain compensation to you. So with that expectation, these managers may do that. Okay.
Yes.
Any query on this? Yeah. So the sorry, manager
But
rewards.
sir, but why would the X Limited company would want the details about why the Y Limited want to purchase them? Because if a company wants to purchase another company, they might have their own reasons. They might agree on a certain amount and then let go of it, right?
Hmm.
Why would they ask any of the information like that?
See, your question is why X Limited will ask information from the management, right?
Yeah.
Now, don't you think? See, here X Limited, I am speaking from the shareholders' point of view. Now, shareholders are not into the regular management activities because just they are the owners. They are not participating in the. They won't participate in the regular management activities. If they won't participate in the regular activities, how they will be knowing about the future prospects of the company? Managers are right persons to give the information about the future prospects, right? See, I am the shareholder of X Limited. If Y Limited offered me a price, Now, don't you think I will be considering my future performance also? Suppose, example, let me put in this way. I am working in a company and let us assume my package is 15 lakhs per annum. Now, another company gave me an offer. So the offer is we will be providing 20 lakhs per annum as a package. Now here first I will be consulting my HR department. What will be my expected increment? If my expected increment is 21 lakhs, will I go with a 20 lakhs offer? Don't you think I will continue in my present position only, right? Instead of going with a new company, if my current company offers a 21 lakh package. I hope you got my point. Did you understood this?
Yes, yes, sir.
So it means that in order to know my prospect, nothing but future performance of an entity, definitely shareholders will consult the management only. And if you see the business valuation, it is the responsibility of the management to clear to give a clear report to the shareholders regarding the prospective financials of the company. Okay, and I appreciate your very good query you asked. I hope most of the participants might have this question, and I believe your question has been resolved. Yes, and one more question here is off balance sheet. Yeah, off balance sheet financing is nothing but intentionally hiding a balance sheet item is known as off balance sheet financing. Why intentionally hiding? There are certain convenience. Convenience in the sense if a company is already having a significant level of gearing ratio, and if they don't want the gearing ratio to be increased, then intentionally they might not disclose a liability in their statement of financial position. That is known as off balance sheet finance. Any other question? I hope all your queries are resolved. Now the manager reward scheme should be clearly defined, be easily monitored, and be impossible to manipulate, and link the reward to the shareholders well, and encourage similar risk attitudes and times. So these are very simple. These are certain reward schemes. So whenever we frame the manager's reward scheme, these are the points which are to be considered. Okay. Now the corporate governance. I hope most of you might have heard about this corporate governance. Now generally, big corporate companies will be having their corporate governance system. Now before discussing this, I want to go back to the Reliance company. Now, can you see these committees here? Is font comfortable or you want me to increase the font? Here, can you see the committees? See, the Reliance committee is having audit committee, stakeholder relationship committee, social responsibility and governance committee, human resource nomination and remuneration committee, finance committee, health, safety and environment committee, risk management committee. So what is the role of these committees? Now, generally, all the corporate governance all the companies in order to achieve better transparency in projecting and processing their business transactions, they do establish certain committees. So if there is any issue in their regular affairs of their business, this committee will be resolving those issues. Suppose if I take audit committee as an example. Now generally in order to create an independent work atmosphere to the internal auditor, or in order to protect the independence of external auditor, and in order to give advice regarding the appointment of internal auditor and the external auditor, and in order to establish an internal control system in the company, audit committee plays a very important. So this audit committee, every committee will have some members, and these members are the combination of executive directors and non-executive. Executive means the directors who are involved in the executive affairs of the organization, who are involved in the day-to-day affairs of the organization, are known as executive directors. So every committee will have the members from both executive directors and non-executive directors. Non-executive means they are not involved in the day-to-day transactions, but they are expertise in that particular field. Suppose if I take audit committee as an example, the non-executive directors are expertise in that particular financial and audit and accounting area. Now, generally, in order to become an independent non-executive directors, uh, we should have a professional degree. It can be an ACCA, or it can be a CA or CMA or a CMA USA or a CMA. If you have a professional degree and if you are having good experience in that particular stream, you can apply as a non-executive director in a company, because very good scope is there for the non-executive directors. So the main objective of the corporate governance is in order to increase the credibility of the company among the stakeholders. If a company don't have an effective corporate governance system, definitely it might affect the credibility of the company in the among the stakeholders. So incorporation of different committees in the organization, so that suppose example, if there is any issue in the risk management, so risk management committee act as a supreme authority to minimize those issues. If any issues are there in the finance committee, sorry, any issues is there in the finance issues, then it can be addressed by the finance committee. So as I already mentioned, every committee will have certain members, and a person will act as a chairperson of a committee. And a company chairperson, nothing but whoever the managing director or a company chairperson cannot act as a chairperson of a company. So the main agenda or main objective of the corporate governance system is to increase the credibility of the company among the stakeholders. So here the major role in the corporate governance is played by non-executive directors. Now, who are these non-executive directors? Who are expertise in their respective fields. Okay, so any queries on these non-executive directors? Yes. And executive directors, do remember, in case of executive directors, as per effective corporate governance system, a single person should not act as a chairperson and chief executive officer of a company. And every director should be re-elected every year. And we should clearly disclose the emoluments of the executive directors. And executive directors should not be outnumbered by non-executive directors. In simple, if a committee is having 6 members, 50%, 3 members should be from executive director and 3 members should be from non-executive directors. So non-executive directors should not outnumber the non-executive director. So these are the points you have to be. Anyway, you do have a separate chapter of corporate governance in your audit and assurance. And it is very important also. Any query on this? EDs and NEDs? Emoluments is nothing but benefits payable to the directors. Remuneration, benefits, all these things are nothing but emoluments. Okay. So any queries, any questions? Yes. So not for profit organizations and value for money and system analysis and an introduction to investment appraisal techniques. We'll have this discussion in the next session because I can understand that most of the participants are already exhausted. So I don't want you to trouble. So these concepts will have a discussion in the next session. So I believe today's discussion is clear. So here a small work I will be giving. So in your LMS resources, just go through this value for money and system analysis. So I want everyone to please go through system analysis and value for money. This is available in the resources of your LMS. So can I expect that? Yes. I want you to respond for this. Yes, thanks for the response. Yeah, any questions on today's session? Any queries? Just give me 1 second. Just I will be taking attendance. There is an LMS sheet. Okay. Yeah. So if you don't have any queries, we can end the session. I hope respected faculty members are there in the session.
Yes, sir. Yes, sir. I'm
Yeah.
here, sir, Dr. Madhu.
Yes, 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 ma'am. So yeah, that's it for today's session. So if they don't have any queries, we can end the session.
Okay, sir.
Okay. So I'm ending the session. So we'll continue, and I request the participants to please go through the system analysis and value for money, which is available in your LMS study resources. Okay. So have a good day. So tomorrow we'll continue this.